America's SEC has just dropped Project Crypto, called the blueprint for onshore crypto, to rewrite securities rules and crown the United States as a crypto capital. So, what would that mean for builders, investors, and protocols? I'm Daria, your usual host, having today joining Parths, your usual co-host, co-founders of EternX, and we're bringing back our distinguished guest, Mansi Birla, a legal heavyweight who's going to help us to decode the fine prints and the newest developments. A disclaimer first. This podcast is for informational purposes only and does not constitute any financial, investment, or legal advice. For any questions, please consult a qualified professional. So now we can dive in.
So yeah, Mansi, welcome again to the podcast, and this one has been pretty soon given the pace at which U.S. Government is working, and this is something that I still remember the years of 2022, 23, where every another news of from coming from U.S. was against crypto, Gensler was suing every other crypto project, and uh, stuffs were pretty bad back then. So. This new crypto project, crypto, has been announced by the SEC. Mansi, can you give us, a quick 90-second elevator pitch what this is and why this is historically significant today?
This is the first time the SEC is actually offering bright line token classification. So, no more guessing if you're building a security or a commodity. I'll just start with the lay of the land before Project Crypto. US crypto industry lived under regulation by enforcement. The SEC was suing issuers and exchanges one by one and applying the 1946 Howey test case by case, and yet offering no formal path for registration of tokens or on chain exchanges. Startups had started to flee offshore, big banks did not participate, and US retail was trading through foreign venues, while headline suits by Ripple, Coinbase were doing the rounds. What Project Crypto does is it's a commission wide mandate to modernize every securities rules that touches digital assets. Key pillars include on chain market structure, clear path for token distributions, custody, and trading. Every SEC division gets marching orders to modernize rules for on chain assets. The second one is Super-App licensing, single SEC license for multi product venues, and the third one being innovation exemption. There's a 2 year sandbox with principle based compliance. It is one of the most sweeping rewrite of the US market regulations since the regulation for the ATS in 1999.
This has been very, very long awaited by everybody in the industry. I know from experience, people had to go to Switzerland, they had to go to Panama, they had to go to all these other places to try to find at least some regulation and be sure they're not going to go in jail in a few years. So, how would this practically guide like future token launches and difference between like security and non-security assets for us growing projects?
Founders can now pick a lane from day one, commodity or security. No more US founders fleeing to Zurich just to avoid subpoenas. Picture the crypto scene about a year ago. To decide if a token was a security, you had to apply the 1946 Howey test, basically, which asks the question: are buyers relying on your efforts to make the price go up? The problem was that the test was applied subjectively. Two nearly identical projects could get opposite answers, and the SEC often made the call after the launch through enforcement actions. The proposed bright line classification has promised an objective checklist. This will allow teams to choose a lane on day one. Either we file a light touch commodity certification with the SEC and live under the CFTC, or do a classic securities offering. Sure, it'll involve upfront paperwork, but you can slash the odds of a surprise lawsuit later on.
No, this makes a lot of sense, Mansi. Like, I can see this is come as a silver lining, but there are overarching questions amongst the different set of projects as well. So, for the projects that are bolted out overseas, there were certain considerations which were much broader also from, beyond the security concerns. But some are already eyeing a Delaware flip back US VC money plus a clear path to list on Coinbase. This is tempting for some, but the calculus isn't the same for everyone. The tax perks which are there abroad, Europe's MiCA rules or privacy-heavy DeFi models may still keep certain teams offshore. So will the exiles come home? What's your take on that?
I think we can expect early stage startups and utility token plays to drift back first. Maybe more mature protocols with global user bases might keep their foundations overseas but open a US arm. Either way, the fog is lifting. Instead of guessing what the SEC thinks, builders now actually get a roadmap, and that alone is a game changer for token launches on both sides of the Atlantic.
Okay. And the custody rules have been always a bottleneck, you know, which is big out there in US. So how does the Project Crypto's custody overhaul interact with the Genius Act, which we all have been, celebrating for some time now?
Simply put, Project Crypto protects the keys and Genius protects the cash. By 2026, DAOs can hold stablecoins using SEC approved self custody rails and not get targeted by enforcement. Project Crypto actually fixes how customer tokens are held. It blesses self custody wallets and expands qualified digital custodians to include banks, trust companies, and vetted crypto native firms that segregate assets and passed SOC 2 audits. The Genius Act, by contrast, fixes where the cash behind the payment stablecoin lives. Issuers must keep 100% cash or T bill reserves in insured banks or money market funds, give holders first priority claims if the issuer fails, and they're flat out barred from paying yield on the coin itself. Project Crypto protects the keys, Genius protects the cash. Users can self custody or use a qualified custodian, while issuers park dollars in bank vaults. The only wrinkle is yield. If a platform wants to offer interest, it has to wrap the stablecoin in a separate security token or route it through an affiliate. Otherwise, the two frameworks mesh cleanly.
But that's certainly going to be helpful for a lot of people developing. There was also a mention of like super apps. Could we dive in a little bit about like what could this horizontal integration of these different legal frameworks mean for existing like centralized exchanges and also like decentralized exchanges, DeFi applications for users?
We see quite a bit of consolidation, and super apps are coming. Imagine Coinbase, Robinhood, and Uniswap merged into one legal on ramp. The Reg Super-App charter folds broker dealer, ATS, money transmitter, and commodity permissions into one license. So a single wallet can list every crypto and tokenized product. Competition shifts from who has the license to whose UI bundles the most rails seamlessly. Big centralized exchanges will add BD security token stacks or partner with licensed backends. Mid tiers may merge or become white label liquidity nodes. DeFi fronts can hook onto a super app's compliance API, giving users KYC once and trade anywhere while offloading CIP and 1099 DA duties. Compliance becomes a commodity SaaS layer, leaving UX, liquidity aggregation, and analytics as the real moats, and blurring centralized exchanges and DeFi into one identity-aware trading surface.
This is amazing because once you that Coinbase has exactly playing by these rules, and it already has a chain, it already has a wallet, it is also probably getting into my understanding is derivatives, and there are different types of things that they'll be bundling in one app itself. So there would be swapping of tokens also happening in the same wallet, and you don't have to actually move out of the wallet. So I think a lot of actions, and within the wallet itself, if you offer, I am guessing that 70 to 80% of the crypto transactions will be happening within the wallet itself. So this is something, when these things have come out, I'm able to relate, what that Coinbase has been, closely watching on these announcements or has has some information on these. Atkins wants to immobilize paper, so 2.0. Like basically he wants to tokenize everything, and tokenization has picking up, be it with digital asset treasury companies, and tokenization of the equity by Robinhood. What do you think the timeline is there for these activities?
I would give it a 24-month runway. Wall Street settlement speed, I think, is about to go Web3 fast. DTC's Project Ion already clears upwards of 100K equity trades in a day, and go can go T plus zero. The SEC's Project Crypto will let an ATS treat a smart contract pool as a protected quote, with a Reg NMS term sheet due Q 2026 and a sandbox for tokenized equities. We can expect pilots to start right away, putting S&P 500 shares on chain inside of 24 months. Corporate treasurers are already issuing tokenized commercial paper, cutting funding costs by roughly 20 to 40 bips. The tech is ready. The only fuse is rule text, and we believe it's been lit.
Yeah, the tech has been ready for a while. It's good to see that now it's actually legal to use it. Okay, I also wanted to ask you something that's like closer to home. As you know, we're interested in autonomous organizations and like autonomous entities, personhoods of AIs and agents. Does Project Crypto change any of the liability exposure for like DAOs or any protocols and companies run by autonomous agents?
So Atkins has actually signaled support for wrapper LLCs and machine proxy entities. We can expect a federal limited robo entity charter with automatic revocation clauses. DAOs will gain clarity on tax, litigation, and agent driven treasuries do get legal standing to sign contracts. So, super excited to see where the SEC goes with this.
No, these are while these things seem to be very rosy, coming off the crypto project, but what, as a founder, the people who are just starting to build, the people who are trying to get in, what do you suggest, between now and the final rules, which is being targeted in by Q4 2026, and we all know, one, like I would say 1.5 years is left between that time. So, and crypto changes a lot within that time. So what would you suggest to those founders, Mansi?
I would say you need to align your token and custody models with Project Crypto right now, or you might miss the on ramp until 2028. Uh, what founders should begin with is first map your token status under the forthcoming bright lines. Prepare dual registration, ATS plus FinCEN MSB if you touch non security assets. Integrate compliant stablecoin rails early. Genius Act reporting hooks will be mandatory. And last but not the least, draft governance to plug into the innovation sandbox on day one. And I think a bonus tip I'd like to add there is maybe budget 5 to 7 months of legal runway for the comment letter cycle. Project teams that co-author the rule book will have the first mover advantage.
Well, all this is very exciting to hear. It looks like Project Crypto might even work finally and bring in the on-chain age closer to us until the mode has moved to the States.
Exactly. For the first time, US law could be the tailwind and not a headwind for crypto builders.
Yeah, I mean, it looks so, and let's hope the rulings come out the pretty soon, so that people can judge and they can understand. But my what in few words I can say is, like, every founder has to keep 5 to 6 months for legal prep, and please keep on continuing monitoring the updates coming from the SEC. It will help you understand what you can do and how you can structure your treasuries and your tokens and stuff. So thanks a lot, Mansi, for this enriching podcast, and we look forward to having you more for more legal updates. I'm sure there is a lot to come over the period.
Thank you
Thank
so
you.
much for having
And
me.
also thank you everyone for listening as well. And see you in the next episode.
Thank you. Thank you.